Hello, and welcome to the House Party podcast with Ivory Innovations. I'm Jenna Louie, a director at Ivory Innovations. Our organization is dedicated to catalyzing innovative solutions in housing affordability. This podcast will tap incredible people from our innovations network. We will bring you the top entrepreneurs, researchers, and practitioners in the industry to shine a light on housing affordability solutions. Today, we have John Green as our featured guest. Let's get the party started. We are excited to have with us today John Green, who is the managing principal at Blackstar Stability and one of Ivory's 2022 Ivory Prize winners. So John is a co-founding principal at Blackstar, and he directs firm-wide strategic planning, leads the investment management efforts, and has over 18 years of real estate and finance experience coming into this role. He previously managed $5 billion in commercial, multifamily, residential, and mixed-use properties in the greater Washington, D.C. area, New York City, Baltimore, San Francisco, and other major metropolitan areas across the United States. For a decade prior to founding Blackstar, he served as managing director for McFarland Partners, a San Francisco-based real estate private equity firm. John earned his MBA from Harvard Business School, an MPA from Harvard Kennedy School, and holds a BS degree in systems engineering from the University of Virginia. John, we are so excited to have you here.
Thanks so much for having me, Jenna. Happy to join.
Yes, and I know I just read off a bunch of accolades about your background, and it's incredible, right, to see people with such a wealth of financial experience coming into the housing industry. Of course, there are a lot of people who have that kind of deep experience, but you don't always see kind of private market side people coming into the affordable space and the affordability solution space. And so I'm curious if you could, paint a little bit of a picture for us. What is your background, and how did you get started, with all of those incredible roles that I just went through?
Yeah. So for me, it's funny, looking hindsight's 2020. Looking back, it all feels like a very natural progression. So I was an engineer undergrad, and out of undergrad, my first job was working as an investment banker with tech and media companies. But in my personal life, I bought my first place, a tiny little co-op in Brooklyn, where there was a lot of change happening in the environment around. There was a lot of gentrification happening in on the edge of Fort Greene in downtown Brooklyn. And so I got really interested in how that real estate development affected the way that people lived, worked, played together, and how it just influenced the environment. And so I just started to pay a lot more attention to that sort of thing. So a couple of years later, when I went back to grad school, I was really focused on studying those issues. So I did a joint program with the business school and the public administration program where I could focus on those sorts of issues, the sort of market failures that affordable housing policy is intended to address, and the sort of solutions, public private partnerships and otherwise, that seek to influence those. So for me, the work that we do at Blackstar really is an extension of a lot of that work, and a set of interests that's existed for a really long time.
Wow. Yeah. And so, it is always fun to hear people's stories, because for most people, right, this is an idea that started germinating well before maybe you founded the actual fund or the actual company where you're working on this issue directly. And so let's talk a little bit about the issue that Blackstar tackles, which is supporting people who have what are called contracts for deed. And I hope I'm saying that right. We also abbreviate them as CFDs. So what is a contract for deed, and when did you first learn about them, and what are they about?
Yeah, absolutely. So I first learned about these CFDs. You're absolutely right. When I was in grad school, so studying in particular the sort of market failures and the sort of deficits and the availability of traditional mortgage financing, and what happens when any form of consumer finance that is highly demanded but not available happens. And CFDs are very much that. Contracts for deed are a form of seller financing that it's a legal contract that is an alternative to a traditional mortgage. But in contrast to a traditional mortgage where a family takes ownership and possession at the same time right away and finances with a third party, what instead happens under a CFD is that the buyer takes possession, but the seller retains ownership and title until the very last payment's made. So all of the obligations of ownership run right away to the buyer: maintenance, insurance, taxes. And what happens in most of these arrangements is that less than 1 in 5 of these buyers ever ultimately becomes the owner of the property. They have an arrangement where, in many cases, that may not be entirely clear to the families who are buying. So they may have this illusion of ownership that doesn't really ring true. So they may be investing sweat equity or real capital to improving a place, only to realize too late that it's not actually theirs. They're usually paying above market prices for it. So the interest rates tend to be higher than prevailing rates otherwise. And in most cases, the prices of those contracts are higher than the market price of that property. The obligations travel without the benefits. So while they're on the hook for maintenance, insurance, and taxes, they don't have the right to sell, to transfer, to lease that property at all. So you can have your payments on time for 10 years, get a job opportunity elsewhere, and have no benefits for having done that throughout that time frame. No rights to claim or to do anything. And to the contrary, the more equity that accrues, it makes you more susceptible target for equity stripping, right? And then there are just very few consumer protections. So it's largely unregulated at the federal level. It's subject to a patchwork of state level regs where things as fundamental as recording a contract, it's not consistently required. And so that can be a real problem in this space. And a big part of how this is wielded is that there are none of the sort of foreclosure process protections to the extent that anyone ever goes into delinquency or default. So no way to protect your interest. So you're subject to a process that's called forfeiture, which is essentially an aggressive form of breach of contract, an aggressive form of eviction. So even a single delinquent payment can trigger this process, and a buyer can lose all of their rights.
Wow. And so we started out talking about, what is a CFD, and it's an alternative form of financing, but it enables people to act like owners without any of the benefits of ownership, is what I'm hearing, right? You've done everything right. You've paid your quote unquote mortgage, which is not really a mortgage, on time for 10 years. You get a new job and you have to move. But you don't get any of the benefits because you didn't own it. And so you can't sell your right. You just have to walk away, even though you've put in 10 years of payments, 10 years of improvements, 10 years of taxes into that property. I can see why, fewer than 1 in 5 people end up taking ownership of that property at the end of the day. I mean, life changes. And if you can't have your financing change with you in a traditional way, that is incredibly hard.
Absolutely. Absolutely. I mean, if you think by parallel, if everyone who used a mortgage could only own their property if they fully paid that mortgage off, that's kind of the parallel, right? How often does that happen? People move, life changes, and these people don't have the flexibility to accommodate that.
Wow. Well, so I guess tell us a little bit more. We've started talking a little bit about why, why some of the people who hold CFDs wouldn't end up as owners. Who are some of these customers? Who ends up signing these contracts? Where are they based around the country? What kinds of houses are we talking about?
Yeah. So we're talking about a product that disproportionately affects low and moderate income families, and disproportionately affects Black and Brown communities. Geographically, we tend to see this most prevalently in places where there are weaker consumer laws at the state level and lots of low-cost properties. So overweighted in the Midwest and in the South. The families are a broad spectrum in terms of who are affected by it. Some families are completely sober. They realize that the arrangement itself is not quite a mortgage, and they realize some of the contours of how it's distinct and what it means. But many more that we've encountered don't really appreciate the fact that they don't already own the property. They think that this arrangement while it may or may not be a mortgage, and in some cases they refer to it as their mortgage, they don't appreciate that not having title means that, that their rights are much more limited. And so, um, the rationale for families can vary. In some cases, they may have had more limited alternatives, and so that could be for lots of reasons that they otherwise weren't able to finance. Um, in other cases, uh, the financial wherewithal, the credit worthiness was not the challenge. The issue was that small balance mortgages tend to be much less available than they are demanded. A really interesting stat that we keyed in on is that nationwide, less than 30% of all properties that are $70,000 or less are financed with a traditional mortgage. That has much more to do with the fixed cost of originating mortgages than it does the credit worthiness or financial conditions of the prospective borrowers. And so if you or I go out and try to get a 50, 60, $70,000 mortgage, you're going to have a harder time than you would think. And much harder than if you're trying to get a $300,000 mortgage in the same markets.
Right. And so this is really interesting, right? Because, in the housing affordability world, we talk about starter homes and housing availability and finding units that are affordable to people on their incomes. And what you're saying is that, sure, if you can buy a $300,000 home, that's great. You probably have some financing available to you. And if you have good credit, there are these programs that can help you afford that and help you end up with a traditional mortgage. But if the balance of that property, if the amount of that property is too low, even if you're doing all the right things, you're saying, hey, I want to be an owner. I have enough money to put into a house. I don't want to rent, but I'm in a place where there are some very, very cheap houses. You might end up in one of these alternative financing options just because there are not traditional things available. And so through no fault of your own, it's really systematic. There's not good opportunities for people, even though, they're doing the right thing and they can afford it on a monthly basis. That is hard.
That is absolutely the unfortunate reality. And even further to the point, to the extent that you are fortunate enough to secure financing, almost invariably it will be at a higher cost than it would be for a higher balance loan, and it will be on worse terms. You're much more likely to have prepayment penalties and more expensive prepayment penalties, higher interest rates than you would on a higher balance product. That's
Wow.
the families who can afford the least tend to pay the
Yeah.
most.
So tell us a little bit more about the solution side of it. What does Blackstar do to help support people who have CFDs?
Yeah, absolutely. So Blackstar Stability is a real estate investment management company that is focused on um, expanding the equitable ownership of affordable single family housing, and we do that by attacking um, forms of seller financing that we consider at best problematic, but much more often outright predatory. In particular, a lot of the sorts of contracts for deed that we encounter, but also similar sorts of products that maybe look and feel and behave, very much like these contracts for deed. Ones where the typical landlord obligations have been foisted upon tenants, where there is not necessarily um, uh, practical, predictable way for the tenants who may be on the other end of, for instance, a rent to own or a lease option agreement to practically finance at the tail end. And so what we do is to buy large pools of properties, outright fee simple ownership, and properties that are encumbered by these sorts of contracts. And we're generally buying them at meaningful discounts. And then we work with the families who occupy those homes to extinguish those contracts, to replace them with traditional purchase and sale agreements that are financed by mortgages that we use our funds to take back. And we've raised a fund specifically to acquire properties and to migrate into that form of financing. We dramatically improve the financing terms of those of the debt versus the previous contracts. We're in that process reducing interest rates. We are, by extension of just completing the sale, handing over title and by in that process any equity that's associated with it. So no notion of shared appreciation, shared equity, or B notes. All of that equity in our judgment is rightfully the property of those families. And to the extent that there are penalties or any negative equity, we actually extinguish those as well. We absorb negative equity to ensure that families are not underwater, and we absorb the cost of originating and funding the escrows for that. For those mortgages that we create, we then hold and season them for a period of time, and then eventually sell them in the secondary market and recycle that capital. So our focus is on trying to confront the issue of CFDs and similar financing and replace them with traditional mortgages. And in that process, hopefully become much more effective lenders, servicers, operators of properties at this sort of smaller balance end of the spectrum for families who are outright owners.
Wow. And so we had just talked about, right, there's a systemic failure here because there are people who have these contracts because they didn't have any other better option. And so they ended up with something like a contract for deed or other kinds of predatory financing. And what Blackstar is doing, if I'm hearing it right, is coming in and saying, look, we're going to buy a portfolio of these houses, of these sort of alternative financing products. And that might be 100 families, or it might be 150 families, or whatever it might be. And we're going to take them and convert them into traditional products, right? And traditionally, people didn't want to originate these mortgages. Banks don't look at them because, hey, the fees are not right and it doesn't work for us. But Blackstar can take those costs on, can take that risk on, and has a business model that makes it work and kind of makes this capital evergreen, right? Because you are holding them, converting them, eventually selling them. And then with the sale money, you then can put it back into more contract for deeds and converting them all over again.
Yes, yeah, that is absolutely the idea, and we're in the early innings. So we have a portfolio that's a couple hundred properties that we've been specifically working toward that end. A lot of families that we've been able to help in that process, and we are in the late stages of closing out our first fund. So by the end of the second quarter, we'll have our final close on a fund that will be $100 million. So we're very excited about that.
Wow, that is meaningful capital that you are bringing to bear. And I guess that's one of the other things I'm curious about. If you've gone on this big learning journey around contracts for deed and around these alternative forms of financing that maybe I assume most people in the housing industry, are not talking about day to day, right? They're saying, hey, we need to help low to moderate income homeowners or low to moderate income buyers. But, you're not always talking about these really small balance properties, as you've said. So what has it been like sharing your findings around this issue and getting capital partners aligned with Blackstar's mission in order to raise this fund?
Yeah, it's the feedback has been great. I would say the initial reaction from most is shock. Right, it is a huge industry. There's more than $200 billion of this product that's out there, and I think that surprises many. That's that the analog I give. My oldest son, when he was just a toddler, he got sick with something called hand, foot, and mouth disease, which I'd never heard of before. Plenty of parents had. I'd never heard of it. It sounded like something that we should have eradicated around the time we got polio, right? I wasn't familiar with it, but as I learned about it, it was just shocking that it still existed to some degree, right? I think when folks hear about this product, they're just shocked that somehow redlining doesn't quite exist, that so many other problems have been confronted and extinguished, that something like this exists at the scale and prevalence that it still does today. This is a product that's existed for more than 100 years in this country. At one point was a predominant form of housing finance for families who were excluded from the traditional mortgage markets through redlining. And so to understand how much of a problem that it continues to be, I think really shocks a lot of folks. I think the solution itself and the approach that we're taking is one that folks have really seemed to embrace, and we're excited by that. We've had a lot of different sorts of prospective investors to join our base, but as well as to underwrite and scrutinize and to really give a hard consideration to. So we're very proud making it out the other side of that, where folks are, have pretty consistently seen the wisdom and the approach that we're taking. So, that I think I'm very encouraged that hopefully we have a solution that is not only scalable because it's market driven, but it's something that others can follow to the extent that we can demonstrate that it can be done well and properly. Because the scale of the problem relative to the scale of our fund is completely asymmetric. We need to have a lot more folks active to really confront the issue.
Yeah, when you said that there's, you're raising $100 million fund, which is incredible. But then you said, if I heard right, $200 billion of these contracts exist in the country, and not all of these are even well recorded, is something you'd earlier shared, right? So the number might even be higher than that. It's rare that I say $100 million is a drop in the bucket, but it seems to be the case here that there's just so much opportunity. And one of the things we love at Ivory Innovations is finding people who are working on some of the biggest issues and have innovative solutions and say, hey, come join us, right? There is more room to do good here. And we have a model, and we would love for others, to join us in this space.
Yeah. The partnership with Ivory Innovations has been extraordinarily helpful for our team. I think one of the things that happens when we reach out to families, it sounds too good to be true, right? Especially at first, because it literally costs them nothing. So we purchased their home and it's subject to this contract, and we tell them we have a much better deal that's available to you. And in many cases, these are folks who have been preyed upon, before. So there are lots of ways that we work to establish and earn their trust, and ultimately the facts are on our side. But one of the things that happens when folks look up, who Black Star Stability is there's this fantastic video that Ivory was able to put together in support of our efforts, and they hear from real families who've worked with us in their own words, and it helps to accelerate that process of earning their trust. So, being a part of this sort of ecosystem of folks who are rowing in the same direction, solving a lot of related issues, has been, an honor and privilege. So, definitely deeply appreciative of that opportunity.
That is exactly why we do the work we do at Ivory, is to try to bring this industry along and help others see, right? There are good ideas out there, right? It's a hard industry. There are a lot of big challenges when it comes to housing, but there are some really promising solutions that are doing great things, and highlighting those. Well, on that note, I'm excited to ask our wrap-up question, which is, what can we look forward to for the rest of the year when it comes to Black Star, or when you think more broadly about what's happening in the industry right now? Of course, there are some big challenging headwinds when it comes to affordability. Many people talk about these in the news, but there's also moments of light and moments of hope. And so what are you looking forward to as you look out across 2023?
Yeah, it's a very unique environment, right? We're coming off a year where there were 7 rate hikes, and we just experienced another yesterday, and the sort of interest rate environment, the volatility, the sort of uncertainty that's wrought by banking failures, these sorts of things create a really unique environment to try to get things done, and we have tried to see it as both a landscape where it's important for us to stay the course, but also to recognize opportunity to potentially play offense. And so on the docket for us in 23 is to find ways to continue exploring ways to expand our offering to our buyers. So in a few important ways. So we've been piloting a program where we work with families to address some of the deferred maintenance issues that they have on some of their properties. And so we've been, that's much easier said than done. But it's important work that we're committed to. So we're figuring out how well and we can operate on that. Also looking to explore ways to more directly integrate the sort of specialty servicing needs that we have and origination needs to potentially bring some of those things under the umbrella and do those directly. So many of those are things that we work with third parties to execute today, but we think part of what's wrought by the interest environment is that a lot of the activity that had been focused on refis have evaporated, and that may represent an opportunity for us to be able to acquire some of that at a much lower basis than we could have ever hoped to, and at a much faster rate than if we were to try to go state by state and organically, secure licenses and expand. So we'll be focused on those sorts of issues in 23, and we're excited to, continue to focus on how we can serve these families well.
Well, John, thank you so much for joining us. Thank you for telling us about the incredible work you're doing with Blackstar and with your team, and really for people who deserve it, for people who have ended up in some predatory situations, and how we get out of it is so important as we think about what's happening in housing today. Well, thank you again, and looking forward to catching up soon.
Thanks so much for having me. It's a pleasure. Take care, Jim.